Hi, welcome to Market in a Minute. This is where we analyze the markets, looking for opportunity, and most importantly, protecting our downside when we think we need to. October tends to be the spookiest month of the year for multiple reasons, right? This is the month where the biggest declines have occurred in the stock market. The market tends to bottom in the middle part of October. So we need that 10-year Treasury yield to go lower. So we need a rally in the bond market to get that 10-year Treasury yield down. Walking through the seasonalities, I really like these charts. These are depicting what happens seasonally. The blue line is the seasonal patterns. The red line is a correlation of where we are currently. This is telling us that the market tends to bottom around October and to have these large returns in the fourth quarter. Starting in the middle of October, you get about a 2% increase, and then another 2% in November, and then a 0.5% increase in December, getting you about 4.5% return for that fourth quarter. The S&P 500 declined about 4.9% in September. That's in line with our expectations. We thought the market would fall 5 to 10% in the August-September period. It actually fell roughly 7%. So we were dead on with that. So for the market to rally, we really need that 10-year Treasury to fall in yield to get that 4.5% return in the fourth quarter. Starting with the 10-year Treasury yield, it bottomed at roughly 3.4%, now 4.7. That's a major increase in yield over that time period. And the earnings have sort of bottomed out. Last quarter it was down 4%. We expect now in the third quarter the earnings to be flat, probably be up a little bit, and then in the fourth quarter earnings to be up about 8%, just because the comparison is so easy with the fourth quarter of 2022. Not that we see a major increase in the economy or anything else happening in the fourth quarter. So we need the 10-year Treasury to come back down around where the 50-day moving average is, and then we need earnings to come in line with expectations. We have fairly good confidence in the earnings coming through, but we don't have a lot of confidence yet in that 10-year Treasury yield coming down. The technicals of the stock market, as you know, we've been defensive here recently as we broke through the red line here, the 20-day and the 50-day, and obviously broke through the 100-day as well. So we were too far above the 200-day moving average. The market had a fair amount of risk, and we got defensive. So we're defensively positioned. We think the market needs to come down to the 200-day moving average and hold that level, and or go back above the 100-day moving average. And if it just goes back above the 100-day moving average, it doesn't give us a whole lot of return from that point forward. So we'd like to see it come down to 200-day and then hold that level, and then see the 10-year Treasury to go down below 4.25. We could have a nice year-end rally if that would occur. But this isn't the rally, it's a rally. Let me walk you through this. So we think over the next 12 months, we're going to go into a recession. The risk is we have another 10+% decline in earnings, and maybe the 10-year Treasury holds around where it is or goes a little bit lower in yield. We still have some downside, maybe significant downside in the overall markets. The other risk is we had the 10-year Treasury go up to 5%, and then we get a drop in the PEs of the market to 15 times. The PE of the market next year is currently about 17.4 times. So it's come down from 19 times to 17.4. But the 10-year Treasury has gone up so much in yield that the current value of that 10-year for PE, for valuation purposes for the S&P 500, is roughly 16 times earnings. So the market has risk to it. The market's overvalued relative to interest rates. So what do you do in this period? Well, we have a couple of thoughts. One, you need a good quality portfolio of stocks, but then protect it. Use some hedging or raise some cash. The cash market, the 3-month Treasuries yielding well over 5%, that's a great place to park money, but be defensive. In the short term, we might get a nice rally. So we're going to play that if we get it. And if not, if the 10-year Treasury tends to go back up, we're really cautiously positioned currently. What to do with your money? So thinking of wealth management, what to do right now. We love the yields in the market, so there's ways to play that, either through the short-term Treasury market or by BIL, that's the ETF. Again, BIL, that's the short-term Treasuries get over 5%. Or I manage a strategy that yields over 7.5%, still very conservatively positioned, but it kicks off a great yield. Tactically, we really like high quality portfolios, but we're protecting those portfolios right now. So put the protection in place. If we get a rally in the 10-year Treasury, meaning the yields drop, we're going to get a nice rally in the stock market in the fourth quarter. The valuations have improved, currently 17.4 times next year's earnings. We think that the valuations should be about 16 times next year's earnings, given the level of the 10-year Treasury currently at 4.7%. So you can see we need that rally in the 10-year Treasury to come down in yield to get the stock market up. Now here's another risk. So we think we're going to go into a recession next year, and the earnings to decline roughly 10 or 15%. So if that doesn't occur, perhaps the other risk is we get the bond yield to go to 5%, and then we get our recession to occur. But if the bond yields go to 5%, the PE multiple drops to 15, and the earnings drop, and we have a good size bear market to occur. So we think it's appropriate to be conservatively positioned. If we get the opportunity to play a rally, so meaning the yields come down in the 10-year Treasury, we'll play that. In the meantime, this is not the point of getting real aggressive, but it is an opportunity to make some money. Next year will be the opportunity to get aggressive for a multiple-year period move up in the stock market. Thank you very much. Please hit like, subscribe, come to my website, Patrick Abbs CFA, and sign up for Market in a Minute hard copy to be emailed to you directly. Take care.